Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And it's been a while since I've done an analysis on a given company, and so today might be a good idea for us to go over one that seems to be pretty popular, one that I've had my eye on for over a year now. And so we're going to talk about Dropbox. For those of you who are new to the channel, I am a popular investor on eToro. You can click on the link below to check out the fund that I run there and to check out how the portfolio is doing. You can just add us to a watch list. If you haven't already subscribed and liked the YouTube channel, I greatly appreciate you doing that. It helps the algorithm. And if you've got comments and questions, of course, you're welcome to get stuck into that. So today is something that it's not necessarily tied to the eToro portfolio. We don't have a position in Dropbox. I also run another family office fund, and we don't own Dropbox either, but I thought I would give my thoughts because it is an interesting company in times where we've had a recent tech-driven sell-off. So a recap, with a crisis investment formula, we are looking for companies with low debt, with a margin of safety, sales growth, strong margins, free cash flow growth, and share buybacks. So we're going to run Dropbox through this formula today and see how it stands up. Quick overview of the company. Okay, so revenue expected to come in at just shy of 2.5 billion US at the end of 2022. If you look at it over recent years, it's 12.5% compounded annual growth, which is very good. If you looked at it prior to 2020, it was actually 20% from 2015 to 2020. So very strong grower. EBITDA expected to come in at 837 billion, and that's a really, really strong EBITDA growth of 20% compounded annual growth rate. So a few things to note there. One, the growth rate is extremely good, and two, they are increasing their margins when you look at the delta between the revenue and their EBITDA. So the EBITDA margins are compounding as well as the straight up revenue growth. Market cap at the moment 9.5 billion, enterprise value 10 billion, so nice clean balance sheet. The price at the time of recording $23.96, 380 million shares, and the company is very good at buying back. So they've got 1.1 billion in worth of buybacks over the last 12 months, and that does have a net decrease in effect on the share float. Not as much as you would initially think, because a lot of the management's compensation is stock-based compensation. Okay, so it's tied to performance and they get allocated stock and stock options. That means that when you see a dollar amount allocated for buybacks, it's not going to be 100% of that amount that gets allocated to reducing the shares on issue, because you're going to have some shares being issued to management tied in with their performance, which is a good thing because it means the management's incentives are tied with the performance of the company. Return on capital over the last 12 months, about 11%. It's listed as negative prior to that, and I think it's because they have a growing equity base in terms of shareholder equity being increased. Net debt to EBITDA about 1 times at the moment, so comfortable balance sheet. If we take a look over the last 5 years, you can see the company has basically over the long term gone nowhere. So if you're looking at the price of the shares alone, you've seen some of these spikes and dips and spikes and dips. That's mainly saying more about the valuation metrics used. So if the market's willing to pay more for these types of businesses at certain times versus the cash flows. It's not that the cash flows are fluctuating this much for a company like Dropbox. In their sector, that you're looking at mainly EV to EBITDA as the main metric which companies will use. And so if the sector is, or if the market's willing to pay more for companies in that sector, the EV to EBITDA ratio or multiple will increase, and then it will be a fluctuation more to do with the amount the market's willing to pay rather than the actual earnings of the business itself. So if you take a look at the market cap, similar story here, and you can see we've been hovering around this kind of 9 to 9.5 billion over the last 12 to 24 months. Looking in on slightly more narrow views over the last 12 months, the stock is basically where it was. They have reduced some of their shares on issue, so although the price is relatively the same, you could actually add a little bit more to the value, or if you think about it the other way, because the price is similar to where we were a year ago, but they've reduced the shares on issue, the true price, if you want to think of it that way, is actually a lot lower than what you will see in terms of the quotations. Okay, some key points here. I'm sure most of you are familiar with Dropbox, so I won't go into the ins and outs, but it's a software company specializing in cloud storage and particular work systems and applications. Cloud storage is very commoditized, and so management are aware of this. They seem to be focusing on vertically integrating their business so that they have a lot of different offerings and they can sell that as a package services to mainly SMEs, okay? And their acquisition of HelloSign, I believe it was, it is testament of that, where they can have an integrated business where you've got your storage and they'll have all sorts of work-based systems, I'm sure, and an application that you can sign and send documents digitally, which is becoming very popular. It's interesting. I must admit, there are a lot of common criticisms about Dropbox's business model, and I kind of felt that I agreed with them, and I still do to a degree over time. Dropbox is very interesting, but it's one that will take a lot to convince me. I want to see an absolutely crazy opportunity before I would enter the business. So its common criticisms are that it's kind of an application or a feature rather than a business model. So if you've got cloud storage, and that the sentiment at least is that is its business. It is just cloud storage. It's not quite true. It's not quite fair to say that. But if you look at, say, Google with their G Suite and OneDrive, I use OneDrive on Microsoft, which is very good. There's a hell of a lot of cloud storage out there that's completely free and part of these other businesses. So Google obviously is a massive company, many different applications. Same deal with Microsoft, and cloud storage is a very big industry, but you're competing with these companies that are offering it almost for free or at very low cost. So how long will Dropbox be able to hold their niche? That's always the thing that's in my mind. It's a feeling rather than necessarily reality, but Dropbox seems to defy that. It seems to be able to overcome this idea that it's got lots of huge competitors, which I just mentioned, with offering free or very low cost services that are basically the same. Dropbox's model is, I think of it as a freemium business model. So you can sign up for free as an individual. You can get access to, I believe it's sort of 2 gigs worth of cloud storage for free. They've got 7 million users, and that's been growing quite nicely over the last 5 years. And you've got roughly 16 million of those are paid users. They've got the HelloSign application, which I mentioned, which really gives light to the ability of the management to vertically integrate this particular business model. And I think that's the key for something like Dropbox. They can't be a one-stop shop. They can't be a one-trick pony. They must become a one-stop shop where they have lots of different applications in one easily packaged, easy to use business offering for ideally a monthly subscription. Many SMEs use this function. I'll give a personal anecdote. So in the industry in which I'm very familiar, which is medical and allied health, is my background here in Australia, a lot of your businesses will use Dropbox as part of their note-taking or file storage. So if you, for example, you have a patient notes, they now get stored on the cloud, and a hell of a lot of applications that are commonly used in businesses where I am and with which I've had experience is that it will be Dropbox backing up those patient files. Okay, so it obviously works, and businesses are using it. They're finding it useful. They're paying for it, and I think that it's at the enterprise level where Dropbox will have its success if it's to grow their premium users moving forwards. I think of Dropbox kind of like a weed. You think, oh, well, that'll just die out or it won't be able to grow, but it doesn't. I mean, it just keeps continuing to pile on the users. The premium users have grown at almost 8% year on year, and that's pretty good. I mean, if you go back and look at the registered users, they just keep piling them on, and their churn rate is very low, so they'll be able to have all these users there. And I think the trick then is, as I've said, vertically integrating it so they just keep selling different things to the same user base. Okay, so finding out everything that they possibly can that goes with cloud storage and all the technological offerings that they have, finding related products and services, either developing them in-house or going and acquiring them and bolting them on to their current business. They do have plenty of cash that will allow for buybacks or mergers and acquisitions or R&D, which I just touched on. If you look at the space, they are relatively cheap value. They will, but I think anything's at pretty cheap value compared to, say, Zoom at 45 times cash flows and all this sorts of thing. I think that Dropbox will suffer less from in a rising interest rate environment than some of their peers, because obviously they're an asset-light business. They've stated they want to reduce their workforce even more. They have been doing so over the last few years, which is very good, become more efficient, and they have little debt. So it's not a company that's very sensitive to interest rates, which is good. Potential upsides from valuation expansions, but at the moment, I am being super conservative with this moving forwards, because if we are moving into what I think will be a more inflationary environment, we will start to see valuations come down, okay? And the cash flows of a given company may stay the same. Their margins may be eroded by inflation depending on the company. So you may have this reverse effect. Instead of having growing earnings and growing multiples, which Peter Lynch calls those twin engines, it may be the reverse. So it might be the twin specters of death, where you've got your earnings being eroded and the market willing to pay less for them. So you've got to be very careful of that moving forwards, and I've been pondering that a lot recently. If you were to buy the company today, you're getting a free cash flow yield on the market cap of 8.15%, which is not bad. Bear in mind, inflation could be anywhere from 5 to 7%. So if you want to look at the real yields, it might not look as good. But relatively speaking, by far and away in that space, it's the best value in terms of a yield to price compared to the other competitors in the space. Few little graphics I thought were important. So if you look at some of the competitors which I mentioned, obviously they're huge. If you got Amazon, Microsoft, Apple, Google, probably the biggest and most powerful companies in the world as your competitors. So do you want to, how are you going to deal with that? Dropbox would normally, I'd look at this on paper and say this is a perfect acquisition candidate for these businesses. So, Apple could come in and I believe did try to buy Dropbox, and the CEO said no. So that tells me that although on paper this looks like perfect acquisition, I'd get in there, I'd buy it, and I'd expect an arbitrage, because any of those companies, except for maybe Box, could come in, buy out Dropbox at a huge premium, and it would still be value accretive to their shareholders. Apple could do so, they tried to do so, but it's the CEO and the management team, they're saying, no, we're backing ourselves. I mean, which is good, but obviously that takes away the arbitrage play, and so you need to bear that in mind with your own valuation of the company. This sums it up quite well. So their paying users has more than doubled since 2015, which is quite decent. I mean, that's a really good sign. They're growing more users through the top end of the funnel, and they're also growing the number of users that are signing up for their premium products. Here's a look at relative valuations in the sector. Okay, so if we go through and you look at Dropbox, Microsoft, Adobe, and so on and so forth, which I mentioned, look at the valuation multiples for these. I mean, it's just insane, a lot of these. I don't even know what most of them do. DocuSign, I don't know how profitable DocuSign is, but it really it doesn't matter to me at 44 times the EBITDA and 45 times the free cash flows. There's got to be a lot of growth to get your investment back and to justify those multiples. And when I look at a macro situation that looks more likely where you're going to have multiples come down rather than continue to rise, we've got to start to be a little bit careful in terms of what we're paying for businesses. So obviously Dropbox is by far and away the standout pick here if you're looking at valuation multiples. And so if we continue to move on, I'm going to be super conservative in terms of the multiples that I apply here. So you may, at home, you may go through this and completely disagree, and that's fine. You may apply a 15 times free cash flow multiple, which I see a lot of people doing for these types of businesses. 15 times or 14 times EV, totally up to you, and that will change the outcome. So with that being said, I've given you guys my reasoning as to why I'm being ultra conservative with multiples now, even more than ever before, because I think the tailwinds for multiples have basically run out, and you're more likely to see headwinds than you are tailwinds. When interest rates are dropping, you'll see the multiples expand. But how much lower interest rates going to go over the next decade, 2 decades, 3 decades? We just got to bear that in mind. Okay, so free cash flow expectations, EBITDA, and earnings in here on the left column for 2022. These are the multiples which I've applied, and therefore you're getting your implied prices over here on the right. Obviously, you can change these multiples if you feel strongly about that a different multiple is more appropriate. Totally up to you. The average valuation, equally weighted here, is about $18.55. If you took away the earnings, obviously it'd be a bit higher, but you'd still be in negative territory. So the difference between the price at which the company's trading today versus our implied price using these estimates is negative. So obviously we would be waiting for the price to come down before we'd be interested in that. If we look out a little bit further, however, and we use those multiples that I mentioned, we use the growth rates that are expected by analysts out into the future, and they do seem pretty reasonable, especially considering the way the company has been going. Then we start to apply a longer term outlook using EBITDA, free cash flow, and earnings. Okay. If you've seen me do these before, you'll know that I apply a probability weighting to a base case, a bull case, and a bear case, and then we get a weighted average of the discounted cash flows or earnings over the decade. In sum, if we look at this particular model, discounted back at 20%, because I want at least a 20% return on my investment if I'm going to take the risk of investing in public markets. It tells us that fair value to pay for Dropbox today would be $24, okay, around about the stock price. So if you believe these numbers, you could say, well, look, I would be able to get my 20% IRR over 10 years if I bought the company today, okay? There's not a lot of wiggle room there, okay? There's no margin for safety, however. And so what I've done here is, if you use those 3 inputs, the 2/3 margin of safety would be around about $13.83. If you take out the earnings, and you think the earnings that have all these different non-cash write-downs, etc., in it, and for a business like Dropbox, it's probably not the most appropriate measure to use. Then you're looking at about $25. Okay, so therefore you'd see it's slightly undervalued at the moment if these projections play out. Then obviously 2/3 of that would be around about the $16 mark. So although you're getting sort of reasonably fair value today, given everything that I mentioned before, I would be looking for the shares to drop more around the mid to late teens before I'd want to take a position personally. But that's just me. And again, if you change the valuations, this number here might get more to the sort of $35 to $40 mark, and that would change the equation. That's where the art comes into it. So the science is obviously the actuarial science and the arithmetic inputs behind everything, or calculations behind everything. The scientific art, the art is which inputs do you use, what discount rates do you use, multiples, etc. And you really have to have a qualitative understanding in order to get decent inputs there. EBITDA, if we pay the share price that I just looked at before, and you get your EBITDA projected out at a given growth rate. So we use the base case, a growth rate over 10 years, and then sell at an expected multiple. You discount that using the company's cost of capital. What would that give me as an expected IRR year on year? And we're looking at about 18.8%, which is not bad at all. Less than the 20% that I would like, but certainly not terrible. We'll beat the market in most years. If we do the same thing using the cash flows as an input, here we come up with 19.6% as an IRR, okay? And again, that's using the base case, using the very conservative multiples. So for me personally, the verdict that I have is that I'm waiting, continuing to watch, continuing to wait, and I would like to have exposure to the sector because I don't think cloud storage is going away anytime soon, and I think that it's a super exciting sector in which to play. I don't have any exposure really, any heavy exposure to the sector because I've just been concerned about the valuations. But should we see interest rates rise, for example, and the market panic, and we see companies such as Dropbox really drop in terms of their valuation, then I'd be interested in acquiring a position in those. So in summary, it certainly passes all of our criteria in the sense that it's a company with low debt, great margin of safety in terms of their ability to attract and hold customers, margin of safety in terms of their ability to grow margins, margin of safety in terms of price. Well, you can argue that depending on the valuations of which you use. So I would say probably not, but then again, if you use more industry median multiples, you would get yes as your answer. The reason I didn't use the median multiples is because I simply think they're too high, and paying, you've got the 45 times for Zoom and these sorts of things are artificially boosting that from what I see. Sales growth, yes. Strong margins, yes. Free cash flow growth, yes. And share buybacks, yes. So it's certainly a quality company, and that's only half the equation. However, we're waiting for the price to match up with I'm waiting for the price to match up with what I think would make the company a good buy. And this is where things are different. So that's just for me. You might look at it completely differently. You might be more comfortable in the space, and so you may be able to come to a different conclusion. Thanks for watching. If you're interested in what I'm doing on eToro, there's a link here, as I mentioned. You can go add the company to a watch list, or if you're interested in a value-based fund, you can copy the portfolio and share in the performance. And if you haven't already liked and subscribed, please do so. It helps me out quite a bit. And most importantly, disclaimer, I'm not a financial advisor. I'm not your financial advisor. I don't know anything about you potentially watching the video. So please understand this is just my opinions. This is what I'm doing personally and with the funds that I manage. It doesn't mean it's right for you. So you need to be super responsible and make sure that you do your own due diligence and that you don't just listen to what I or what anyone else says and go and blindly take action. As I said, this is a channel where I express what I'm doing, and because I enjoy doing that, nothing is advice, nothing is a suggestion. It's just completely your responsibility to take responsibility for your decisions. Having said that, thanks for watching, and I hope to see you again soon. I hope the video is valuable, and I look forward to hearing your comments and thoughts in the discussion section.